Earnings records are shattered. Margins rise. Cash flows remain solid. Yet SMPH finds its stock priced well below pre-pandemic highs. Why, despite operational excellence, has market confidence not followed? This is the paradox at the heart of SMPH's 2025 story. Numbers show strength: 48.8 billion pesos in earnings, robust tenant mixes, and exceptional cash generation from malls. But these are not the metrics the market now prizes. Investors have moved on from growth. They want yield. For years, SMPH built its name as a growth dynamo. One mall after another, ambitious estates, booming residential towers. That fueled premium valuations. Today, growth has matured. The company's narrative has shifted from expansion to discipline. Cost control, operating leverage, predictable returns. Return on equity has stabilized. The era of hypergrowth is over. Investors responded by lowering their expectations. SMPH's valuation is now anchored in yield, no longer growth. The market's question is clear. How much cash can it deliver to shareholders, and how reliably? Yet SMPH remains caught between identities. Dividend payouts have risen. Buybacks are underway. But yields, around 2 to 2.5%, are modest at current prices. Enough to signal change, but not enough to satisfy income investors. The missing piece is structural commitment. True yield stocks moderate capital spending, adopt predictable payout ratios, and shift management messaging toward cash returns. SMPH has started, but not completed this transition. Enter the REIT opportunity. Strategic asset spin-offs into REITs, as seen with AREIT, can unlock hidden value. REITs crystallize billions in embedded equity, raise dividends without suffocating growth, and force clarity in corporate identity. Spinning off mature, stabilized assets accelerates this process. But caution is warranted. Not every mall is suited for a REIT structure. Flagship properties, and those primed for redevelopment, benefit from remaining under SMPH's control. The optimal approach is a barbell strategy. Spin off mature, low-growth malls, retain strategic and redevelopment-heavy assets. This preserves operational agility and yields visibility. Inaction is costly. If SMPH hesitates, it risks remaining undervalued. Too slow for growth investors, too low yield for income seekers. Today's stock behavior already hints at this dangerous limbo. The path forward is clear. SMPH's operational excellence and balance sheet strength have set the stage. Now, true yield orientation, via deliberate REIT monetization and a medium-term payout framework, can catalyze a new era of shareholder returns. SMPH is ready for its inflection point. The company has evolved into a yield vehicle in everything but name and structure. Investors will reward clarity and cash return. The next move will determine whether shareholders finally get paid like it.